China officially says its economy grew around 5% recently. It's a number that paints this picture of, you know, stability of inevitable global dominance.
But there's this startling analysis out there, research suggesting the real figure is, well, dramatically lower.
And we're not just talking about a small rounding error here. One calculation, which uses things like satellite data of nightlights, it implies China's economy is actually 60% smaller than reported.
60%. I mean, if that's even close to being true, it changes everything.
It does. China wouldn't be on the verge of overtaking the U.S. It would be, what, maybe a third of the size of the American economy?
The implications are just monumental, so we have to understand not just if the numbers are inflated, but why.
Okay, so we're going to break down all the forensic evidence, the alternative data, the hidden incentives, and the very real political costs of questioning the official numbers.
Welcome to the IMN podcast.
Our mission is to take complex subjects, just like this one, and make them easy to understand. We do it through these relatively short deep dives, explained in simple language, to give you insights that are often missed.
And today we're unpacking the data integrity of the world's supposed second largest economy.
So where does a problem this big even start?
It's structural. The root cause is really embedded in China's unique governance model.
Right, because it's not like in the West, where statistics are usually handled by an agency that's, separate from the political machine.
Exactly. In China, the national numbers are built from data that's collected by local governments and the leaders of those local governments. Their careers are entirely controlled by the central government.
Ah, okay. So they're part of what some call a career tournament among officials.
A tournament is the perfect word for it. It's this high-stakes internal competition.
And how do you win this tournament?
Your promotion is based almost entirely on meeting these really ambitious growth and investment targets that are set by Beijing. This creates a powerful, almost irresistible incentive to over-report your stats.
If you hit your target, you get promoted. If you don't, your career is basically over.
Precisely. And so the easiest way to make sure you hit the target is to just adjust the data. This whole mechanism is sometimes called the Mandarin model.
And it's not just outside observers who are skeptical. The distrust goes right to the very top.
Oh, absolutely. The most famous example is the former premier, Li Keqiang. He once flat out said that China's GDP numbers were man-made, and basically just for reference.
He didn't even trust his own government's data.
He didn't. He actually came up with his own set of indicators, the Keqiang indexes.
Which were what, exactly?
Things that were much harder for local officials to fake. So electricity consumption, railway cargo volume, and bank lending. I mean, the irony is just staggering. The premier had to create his own spreadsheet because the official state numbers were so unreliable.
And we've seen provinces get caught, right?
We have. Historically, if you add up all the local GDP numbers, the total is always bigger than the national GDP figure. It's a statistical impossibility.
But it shows you how much everyone is exaggerating.
And recently, some provinces have been forced to admit it. Places like Liaoning and Inner Mongolia publicly confessed to overstating their GDP figures, with industrial output being the main culprit.
So the local governments overreport. But doesn't the central body, the National Bureau of Statistics, or NBS, supposed to clean all this up?
They're supposed to be the check, yes. They try to adjust for the discrepancy, but academic studies suggest their adjustments just haven't been enough, especially after the 2008 financial crisis.
Why after 2008?
Because that's when local stimulus spending went into overdrive, and the pressure to show results, to show growth, just ramped up dramatically.
Okay, so if we dig into the numbers, where's the inflation actually happening? You can measure GDP by what's produced or by what's spent.
And if you look at the production side, the gap is almost entirely driven by one thing: the industrial sector.
And on the spending side?
The massive gap is in investment, what statisticians call gross fixed capital formation.
So building things, bridges, factories, high-speed rail.
Exactly, because that's the most visible, tangible proof that an official is hitting their targets. Look at the giant thing I built.
And the numbers there are pretty wild.
They're staggering. By 2016, the sum of all the local investment claims exceeded the national investment figure by about 13% of GDP.
So local officials claimed they invested an eighth more than the entire country was supposed to have invested.
It's a huge statistical black hole. And this is where they have to get creative with the accounting.
How do you mean?
Well, they're inflating both production and investment. To make the local books balance, they have to fudge a third number, and they use net exports as the plug.
Net exports. So exports minus imports, they just tweak the trade numbers until the math works out.
That's it. They use one flawed number to cover for two other flawed numbers. It's a system that basically eats its own statistics to satisfy the political tournament.
Which brings us to the big question for you, the listener. If the official numbers are compromised, how do we check them? What are the independent data points?
Well, there are two main academic approaches. The first one uses tax data.
Tax data. Okay, how does that work?
Researchers look at value-added tax, or VAT, revenue. It's collected by local finance bureaus who have zero incentive to overreport it. In fact, they have an incentive to underreport it.
Why is that?
Because most of that money has to be turned over to the central government. If they overreport VAT, they're just shrinking their own local budget.
So it's a check based on honest self-interest.
Exactly. And when you compare the growth in VAT revenue from industry to the official growth in industrial GDP between 2010 and 2016, you see a big gap. The VAT growth is much, much lower.
And what does that do to the overall GDP growth number?
When you adjust for that, the nominal GDP growth rate drops by about 1.8 percentage points per year. That's the moderate view. Consistent, significant overstatement year after year.
Okay, a 1.8 percentage point overstatement every year is a big deal over a decade. But it's a long way from that claim that the economy is 60% smaller.
Right. For that, you have to look at the second, more aggressive method, statistical models that use satellite data.
This is the nightlights theory.
This is the nightlights theory. The idea is simple. As an economy grows, it uses more energy, it builds more things, it emits more light into space at night. You can't fake that.
And when researchers compared nightlight growth to GDP growth around the world, what did they find?
They found a clear pattern. Autocratic countries consistently report GDP growth figures that are about 35% higher than what their growth in nighttime light would suggest.
So there's this 35% autocratic deflator. But how does a 35% overstatement in a year lead to a 60% smaller economy overall?
It's the power of compounding. It's like a lie that gets bigger every year. If you exaggerate your growth by 35% this year, the starting point for next year's claim is already inflated.
So those small annual exaggerations just multiply and multiply until the final number is completely detached from reality.
Exactly. And when you apply that 35% deflator cumulatively, going all the way back to 1992, the gap just explodes.
That's where the big number comes from.
That's it. The analysis suggests China's real GDP in 2019 might have been closer to $4.2 trillion, not the $14.3 trillion they reported. And that's the 60% smaller claim.
Which brings us to today, because this problem seems to have gotten even worse recently with the structural slowdown, especially the property market collapse.
The chickens are coming home to roost, really. All that inflated investment data was driven by property, and now that sector is imploding. Independent analysts, like the Rhodium Group, they think the official 5.2% growth for 2023 was way too high.
What do they think the real number was?
Much closer to 1.5% to 2.0%.
Wow. So if the official number is over 5, but reality is under 2, where can we see the lie in real time?
You look at the proxies, the things that are too granular to fake. Start with investment. Cement output was recently down over 10%. New property starts, down 23%. Private investment actually declined.
You can't have a 5% growth economy when the building blocks of that economy are contracting that sharply.
You can't. And then look at consumption. The official consumer confidence index is at an all-time low. People are worried. They're not spending.
We see that in the inflation data, too. Core inflation is barely positive. E-commerce sales on major platforms are actually contracting.
It's just impossible to reconcile this deep weakness across the board with an official growth rate over 5%.
And if you're an expert inside China and you dare to point this out,
the consequences are immediate. We saw it with the economist Gao Shangwen.
what happened to him?
He was a government advisor. He publicly suggested that 2% growth was more realistic than 5%.
And his reward.
An investigation ordered by President Xi Jinping himself, and an indefinite ban on public speaking. It just shows you the political cost of telling the truth. The narrative is more important than reality.
So let's just summarize before we get to the final costs.
Right.
What's the bottom line here?
You basically have two camps. There's the moderate view, which says annual growth is overstated by about 1.8 percentage points a year. Then you have the more radical but still statistically driven view that the whole economy might actually be 60% smaller than claimed.
And this isn't just an academic debate. It has real disastrous financial consequences. For example, the official data implies that the corporate and government sectors have this impossibly high savings rate, something like 70%.
Which is just absurd. But if you use the adjusted GDP numbers, the ones based on nightlights, that savings rate drops to a much more believable 54%. The fake GDP number distorts the entire structure of the economy.
And then there's the debt, all that hidden local government debt. Estimates put it somewhere between 75 and 91% of GDP.
And that debt is crushing local finances right now. In a province like Jilin, monthly debt servicing costs went up by more than 600% between 2017 and 2022. It's forcing them to cut public services. It's a real crisis.
So here's our final provocative thought for you to consider. If Beijing were to just admit it, to publicly acknowledge a slower, more realistic economic path, say 2% growth, could that shift in narrative actually unlock the political will they need to tackle this massive debt problem and pursue real sustainable reforms?
Or is the political cost of admitting weakness just too high, forcing them to continue the charade until the whole system just breaks?
Thank you for joining us on the IMN podcast.
We always aim to make complex subjects easy to understand, relatively short, and to provide insights that are often missed.
Remember to subscribe, follow, share all of that across YouTube, Instagram, Facebook, TikTok, and X.